Welcome to episode 5 of Share Views. We are here with a very special guest who's a fund manager of quite decent success so far this year. One of his funds, a gold fund, is up nearly 200% year to date, so it's definitely a situation and a man to watch. His name is Angelos Damaskos, sector investor manager. How are you today, Angelos?
Very well, Zach. Thank you.
Right. We're going to hear today talk about gold and oil. Normally they're regarded as two separate asset classes. Either you like gold or you like oil. You don't really combine the two. What's the reason for your somewhat unusual take on these two asset classes?
Well, I think they are both very topical and very interesting at the moment, because gold, for its part, is very much in the investor's focus because of the general risk aversion. And gold has been regarded since antiquity as a store of value and a safe haven. Hence, we have seen a very large inflow into ETFs year to date that has pushed the gold price higher. And this this rise in the gold price has translated into increased profitability for the gold miners, which has caused the re-rating of the share prices.
But obviously we've come off the back of a horror story in gold stocks, I think, from, let's say, from almost 2010 up to the beginning of this year.
2011 was the peak.
The peak.
So we've been in a 5-year bear market.
Yes, exactly. The gold stocks actually started falling before the price of gold, so it was quite a nightmare. How do we know that this is not just like an intermediate rally and then everything is going to go back to a bear market again? Or does it not matter?
Well, I think you have to look at the longer-term picture. And we all know that gold started at around $250 an ounce back in 2000, 2001. And it has enjoyed a tremendous run up to 1927 in 2011. It might have been overvalued at that time, so it was due for a correction. It just took 5 years to resolve and shake out that correction. And we think that now the real value of gold is starting to appeal again to investors. And with what's happening in the global economy, investors are very much interested into gold. Right,
but the special take that you have, as I said at the beginning, what is the gold and oil. And
yes.
We've got a chart here of the ratio between the two. And what is this telling us? Because this looks to be quite, quite a revelation.
I think it's a very interesting chart, and I believe it can point to imminent financial crisis in the world. And as you can see here, the gray shaded parts are the major financial crises that we have been through. The 2000-2001 dot-com crash, where the ratio spiked up very dramatically. And obviously the much bigger, more severe financial crisis of 2008-2009, with a very dramatic rise of gold. We are now at a much higher level in relation to how much oil an ounce of gold can buy. And I think that that also is a result of the dramatic crash in the oil prices. So oil is particularly cheap at this point in time. But nevertheless, it does point that there is a significant stress in the world economy that could be succeeded by some sort of a crisis. We have seen the Brexit vote. Perhaps the European Union doesn't look as solid as it used to be, so there are a number of risks in the world economy that we see as alarming. And that's why gold is very much favored by investors nowadays.
So even though it's expensive, and really expensive as compared to oil, it's still regarded as being a buy at current levels?
Either that oil has to go up significantly or gold has to come down for this ratio to correct.
Right.
Or some other crisis is due to happen, which could push gold prices significantly higher still.
But what I was saying is that, I mean, the oil hasn't actually, oil has stayed very, very low. Yes. And there is, let's say oil goes down to $20, for instance. How would that affect gold stocks, do you think?
Well, I think there are different pressures and different dynamics driving the oil price. We are in an oversupplied situation since 2014 that has caused the crash. And we are still working out this excess supply, even though there has been a reported $1 trillion of capital expenditure cut across the industry. This has not transpired into a dramatically lower production volumes around the world. We believe this is yet to happen because what this capital expenditure cut has done is that it has completely stopped exploration drilling. So at the same time, in the meantime, demand has kept growing, and when the supply-demand balance is equalized, the additional supply of oil that was due to fill in the gap will not be there. So we will potentially be in a short supply situation in 1 or 2 years' time, and we all know that that's a recipe for much higher prices.
Right, so it could actually be the case of both oil and gold going up at the same time over the year.
Yeah.
Well, that's good to know. All right, next chart is your lap of honor, I think, really, with the performance of your two funds, the Junior Gold Fund and the Junior Oils Trust. Oil, obviously, still way behind.
Yes, oil is still languishing because I have to know that Junior Oils Trust focuses in smaller capitalization companies. So even though we focus on producing companies with good balance sheets and solid production volumes, they are still lag the performance of the mid-cap and large-cap oil-integrated companies. But we think this is coming, this is yet to come, because as the oil price rises, investors will look at the smaller companies as more attractively valued. So the oil fund is about 20% up year to date, but the real success story is the gold fund, where we are the best performing gold fund in the Morningstar tracked universe. And I believe that the reason for this outperformance is that our strategy was developed in the trenches, so to speak. In the bear market years, we focus on those companies that had solid production, solid operations, and were keen to reduce costs and restructure the balance sheet, reduce the debt, and manage their affairs. And we were very keen to maintain viable businesses. So these are the companies that are enjoying the highest expansion of profitability.
It's ironic that some of the larger ones, larger companies, the larger mining companies, didn't actually do that. The Billitons and the Rios weren't actually as sensible or prudent as they could have been. They were in denial in terms of the conditions being as bad as they were.
Yes, but these are integrated miners. They look at a vast array of commodities. They were not hit as hard as the gold mining companies, who suffered tremendously because they had overexpanded in very ambitious, very marginal projects in the bull market years. So all of those projects had to be written off. The balance sheet had to be cleansed and focused on cost control and managing a solid business in the weak years. But these companies are now emerging much stronger because on one hand they are enjoying very high free cash flow generation, which is not impeded by high debt levels, and they still have an inventory of projects that they can put online and increase the production still and enjoy a much greater growth.
Right, so I mean Randgold Resources would be the star in that in terms of being prudent as far as the bigger companies are concerned.
Yes,
but you're focused right down the market cap scale there.
That's right, yes. We don't actually hold Randgold, but it is a very successful company, has done tremendously well. And again, it was by virtue of its model of focusing in high grade projects that had a very solid business viability and managing its balance sheet very prudently, so it survived very well the bear market years.
Right. A lot of our viewers are clearly focused on the UK miners. There aren't that many of them, and you're predominantly based in Canada and Australia. But maybe we can mention one or two of the UK stocks that you like or you're involved in.
Yes. Well, we in Junior Gold, we focus primarily in Canadian and Australian listed companies because there is a much greater universe of companies to choose from. And in our urgency to choose the healthier and stronger companies, we had to go to a much bigger universe. So our exposure to UK listed companies is less than 10%. But the two we like at the moment is Hochschild Mining, which is not that small cap, 1.3 billion pounds market cap. But it's a gold and silver producer focusing in Peru with 3 mines and 1 mine in Argentina, and enjoys very solid growth with significant potential to grow production many times. And the second one is Shanta Gold, that is a much smaller cap, about 40 million pounds, which focuses in one mine in Tanzania, East Africa. So one would argue it's a little bit more of a risky operation because it's only 1 mine and a much smaller company. But they have managed to control costs very well and to restructure the balance sheet, so it appears very healthy and set to grow its production significantly.
Right, and on the junior oils front, there's 3 companies which are highlighted here in the UK, Serica,
Right.
Bolívar and Victoria Oil and Gas.
Right.
Out of those, what are the characteristics you like about those companies?
Yes, in junior oils, we hold about 25% of the portfolio in UK companies because obviously there's a much greater universe, again, to choose from. We like Serica, we have been holders for years. We like Tony Craven Walker and his team. They have done a tremendous job. And the company making acquisition of Erskine, the Erskine field from BP in 2015, has transformed this company with a very strong growth in production and a very solid balance sheet to back it. Plus, it is carried in 2 exploration drilling prospects that would be drilled next year. So it has free carried. So it has this potential to add to reserves with very low risk. Bolívar we like because it basically trades at cash. The market cap of the company is about 110 million US. It holds over $100 million in cash on the balance sheet. And it has 2 projects in Cameroon, one offshore, one onshore, gas focus, which is currently working with its partners, New Age and others, to bring to production and monetize this gas production in Cameroon. And also Victoria Oil and Gas for a different reason. It is also Cameroon focused, but it has become almost a utility. It has had a very large gas resource, which is very near Douala, one of the major export ports of Cameroon, with a very large industrial base. So they sell directly to industrial clients, and they use gas-to-power projects to generate electricity even and increase their margins.
Right, so there'd be you've got 3 long-term, these are like long-term holdings which will continue
right.
to be long-term
That's right.
holdings. The final point really is if people are interested more in sector investment managers, they can look at sectorinvestments.com.
That's right, that's our website, and it shows details of both these 2 funds. These are our 2 UK-listed funds that are very much sector allocation tools, if you like. And they are very widely held. We have thousands of retail investors in each fund, but we also manage some segregated accounts and some other strategies that follow a slightly different approach. But these are our 2 sort of sector-specific tools.
And I take it that as your funds have performed well this year, there's been much more interest than there was, let's say, this time last year.
That's right. That's
right. Well, hopefully that will continue for a long time. Sector Investment Manager Angelos Damaskos, thank you very much for coming in today.
Thank you, Zach.
We'll be back after the break. Welcome back to Share Views. We're here with Andrew Bell, who is chairman of Red Rock Resources and Regency Mines. It must be tough being chairman of two companies at the same time. Does that work out well for you, Andrew?
It works out, yes.
Right, okay. I've got, in honour of Jeremy Corbyn, you know, the Labour leader for life, it would appear, I've got all these questions from the public, you know, Edna from Huddersfield and people like that, relating to your companies and your activities.
Okay, so you're going to pretend to be Jeremy Corbyn.
I'm going to pretend.
I pretend to be David Cameron.
Well, it's exactly, yes, exactly. The late David Cameron. First question actually is quite a sharp and snappy one. In terms of your track record, can you point to any outstanding successes?
Yes, I think that some of our investments in the last cycle, the things that we invested in are still there. We were one of the parties in a joint venture that took over Jupiter Mines in Australia, which developed one of the world's largest, most successful long-life manganese mines in the world. And that has been providing more than 10% of China's manganese demand. It's still there in the portfolio. We sold out a lot of our stock in the last bull market. We also brought into production ourselves a gold mine in Colombia. We sold that, and we've got a series of payments, and we have a promissory note to us, which we think the conversion has been triggered. So we're working on that. And we get a stream of royalties. We got the first royalty just now.
Right, so there are positive things to point to.
Well, those are 2 examples.
Yes, I think the other thing is we've got sort of like a bit of a quick journey around the world, because people have asked about, you know, a project in Greenland, Papua New Guinea, here and there. I mean, is there a quick rundown you can give us of what's going on in these different places? Papua New Guinea, let's start there.
Papua New Guinea, nickel, lateritic nickel. The nickel market was the first to rise in the mid-2000s. and the nickel market was the first to fall and fallen further than others. It's recovered a little, but not so much. We regard that asset as one that is probably not immediately something you can raise money for, but it is one of the world's larger nickel resources that we proved up there. And we proved it up, and before it wasn't proved up. So that's another accomplishment.
Wonderful. Shoats Creek in the USA?
Shoats Creek.
Gas gathering has been the question about that.
Yes. Shoats Creek, oil production onshore Louisiana. Cheap, very cheap production, so we got into that at the beginning of the year, right at the bottom of the oil price, which has risen from $27 to nearly $50. With the gas, that some gas has been produced in association with the oil. It's not been collected up till now, been flared off, and now there is a plan by our partners and ourselves to collect that gas and then to sell it.
Right, okay.
So that pipeline's going in.
We have a question about Migori in Kenya, the license is there?
Yes, we proved up 1.2 million ounces of gold there in the last cycle. We would have liked to carry on exploring, but when the gold price went up, some local people got a bit greedy and a bit of politics came into it, and our local partner found that the asset was being taken away. We have started a case in the Kenyan court, an administrative case, and we're in negotiations with the ministry.
Right. Greenland, I think there was a project there.
Greenland, although I'd be very optimistic about Kenya, I wouldn't be so optimistic about Greenland. That is, so far as our iron ore exploration there's concerned, that's a sort of top of the market, end of the line type exploration play. On the other hand, we picked up at the bottom of the market an interesting rare earths and niobium tenement in the south of Greenland, with again a huge resource, one of the biggest in the world for niobium.
So that's one to save up for when the oil price gets a little bit.
It's one where it cost us just about nothing, and at some point we will find that people are very interested in it.
Right, and then there's a question about the Westport Energy and how it's progressing towards its planned listing on AIM. Is that something?
Yeah, Regency Mines has an interest in Westport Energy, which is going to list or planning to list on the standard market at London Stock Exchange. It's been moving towards that. We have bought a stake. We have the right to take a further stake at the time of listing, and we'll be expecting to put someone on the board at that time. It's progressing. There are some legalities to be concluded because this was an asset coming out of bankruptcy.
Right.
Those are the best assets.
Right. This is a question not from Edna from Huddersfield, but from Zach from Bayswater.
Yes.
Basically, the tie-in with the relationship between you and Metal Tiger. How did that happen? How does that work? And I mean, it seems to be transformational in terms of sentiment, if nothing else. So what can we expect?
Yeah, we've known those people for more than 10 years. They backed us personally in the last cycle, made a lot of money, and we've got a mutual respect for each other. I have a lot of respect for Paul Johnson, and we're not working in concert, but our interests have coincided because we see the world and the market in the same way. And so we've been into one or two companies at the same time, and we're flattered and pleased that he's invested in the way he has in Regency and Red Rock.
Is it correct to regard that as a safety net for you, or is it something which is a sort of something holding your hand, or I mean, how should we regard that relationship?
I think we can all make money.
Right. Okay. Yeah. Okay, that sounds sensible. So we've got somebody who's a larger investor, a long-term shareholder since 2010, with a substantial holding around 3% of the company. I would welcome your views on how you see the next 12 months.
Well, it varies according to what you're talking about. When it comes to gold has been in a bull market for 2 years, which has been disguised by the extraordinary strength of the dollar. I think that gold market is in its early stages. As Lord Rothschild, in his latest report for RIT, pointed out, 30% of government debt worldwide is now negative interest rates. This is absolutely unsustainable. And people are adjusting to a zero interest rate environment that's unreal. There's danger of stagnation, but I think that the greater danger is that inflation reappears very quickly and interest rates go up very fast as soon as people start having to pay, as soon as the cycle turns. And at that point, gold will be the only game in town, because governments are the people who owe the most, and they won't be able to pay.
But isn't it a situation that I mean, that should have happened, it really should have happened from 2009-10, and it didn't.
It didn't.
And it didn't because governments are able to print as much money as they like, they can go into as much debt as they like. The effect of zero interest rates is actually a deflationary one, because all the potential money that savers would have got, the old the Edna's from Huddersfield with their 50k in the Woolwich or whatever they have it, is not being spent. It's been evaporated. So you've actually just got to everything is equaled out at zero. So there may never be this inflation.
Well, governments, being the biggest borrowers of all, have tried to transfer money from savers to borrowers. But in the end, the savers go on strike and they do something else. I don't think it's sustainable. I think it's going to come unstuck. The problem with these things is that markets can remain irrational for longer than you can remain solvent if you're, say, buying gold futures. But if you've got an exploration company that's mainly in gold but has something producing some income, in this case from onshore oil, from gold royalties, and from other sources.
You want to be ticking over in a liquid way until the
You're
party
going
begins.
to be there till your number comes up on the jackpot.
You're in the penalty area, basically.
Yeah, that's it. What a good analogy.
Gold hanging, or gold hanging rather. And but I mean, let's say a year down the line, should this scenario have happened by then? I mean, like, you know, Donald Trump's president, gold is at $1,800. There's a wall in Mexico. All these sorts of nightmare scenarios. Is that what we're looking at?
Well, I'm not too worried. I think that probably commodities have bottomed, because in January, February this year, they got down to ridiculous levels, and you then saw manganese, for example, go from mid-February to the end of February, from $1.40 per DMTU to $2.80. You saw, and it's about there today, having gone down and up a bit, it's perhaps a bit higher. You saw iron ore do the same. You saw a number of commodities perform very well, and of course you saw oil rise from 27 to 50. You also saw from the December lows of gold below 1,100 a move to over 1,300 now, with a strong dollar. So we can say that we saw the panic lows where really people couldn't make money. The probability is that, therefore, things are going to get steadily better from now. When it comes to industrial metals, there's still a question mark about how fast economies, in particular, like China, are going to grow, and whether that will reduce the growth in demand. And so you have a bet on recovery in the sector because it got too low, but how long that retains its great energy and how or whether it's going to happen slowly over a period of years, we don't know. But when it comes to gold, I think there's a different picture. When it comes to oil, I think there's a different picture.
Right, and so for anybody coming to the party at Red Rock Resources now, is it really is it 50% gold, 50% oil, or is it mostly gold? How would you describe that proposition?
I think Red Rock is mainly gold at the moment. We expect dividend flow from our manganese interests. We're getting royalty flow from our gold interest, some of our gold interests. We have the gold exploration interests and resources as well, and we have some revenues from onshore oil, which is really cheap onshore oil. If you can find onshore oil where you can produce it plus or minus $10 a barrel, that's got to be good. It's cash flow, and you've been able to buy that sort of stuff or buy the entry into that much more cheaply in recent months than you have for many, many, many years. So all these other oil companies in London that are doing sort of oil, they got in at much, much higher prices. We've actually done the right thing by getting in at the bottom and having a little bit of cash flow to run your exploration company off. We now decided is a much better model than the model that people were working off, pure exploration plays where you had no cash flow. So that's that. In Regency, We're at a slightly earlier stage in the recovery, but again, that may mean there's more opportunity. We're down at just a little over £1 million market capitalization, and we are investing in an asset that's come out of bankruptcy and doing one or two other things. So, that's an interesting story too.
Andrew Bell, Chairman of Red Rock Resources and Regency Mines, thank you very much for speaking with us today.
Thanks.
That's the end of Share Views.